Can you guys hear me? Oh, okay. Okay, so let me. Can you guys see my screen? Okay. So for reverse mortgage, once you log in, you hit this new loan here. And we really just need a few documents to kind of get started in terms of seeing how much the borrower can qualify for it. We need the value of their property. We will need a recent mortgage statement so we can see how much payoffs we need to include. So this case, I'm going to add a value, the zip code, the borrower's first name, their last name, their date of birth, and then for now, you can leave their contact info blank, but you will need to input it when it comes to sending out the actual proposal and the application to the borrower. So in this case, with your credentials, your login, your loan officer should come up, but I do have access to change the loan officer. You're going to select the product. So in this case, we have several different reverse mortgage companies that we work with. We have Finance of America, also we refer as FAR, Mutual of Omaha. We work with Longbridge. We work with Money House. So Money House is the only one that you will not find within these products. So this one here that we're using is our Quantum Reverse. So as you can see, it has all these different lenders. So I'm gonna go ahead and select the Finance of America here. And then I'm gonna do test loan, but if you guys are ready to start the process, you can go ahead and create the loan. Or if you're still unsure if they want to move forward, you can always create test loan and then change it onto an actual loan.
Brenda, before you go on, what exactly is Quantum Reverse? Is this like a loan sifter for reverse mortgages?
It's the portal that they use. So it's
Who's they?
the reverse lenders. So
Okay,
so reverse is a little different than a regular loan. So
uh-huh.
when you guys usually start the loan and send it to processing team and we upload everything here, right? So with the reverse mortgage, we don't create a Calyx point. So the proposal is usually sent by the loan officer. So you should essentially, if you guys want to start creating loans, you will have your own login to this Quantum Reverse.
Okay.
And you will start the process in terms of sending out the proposal. So this is kind of setting you up for that.
Gotcha.
So right now, we created our loan. So think of this as the Calyx point to our regular loans. So it has all the borrower's information here. So this is where you would input the borrower's social. It would go through, we have to go through their questions for the declarations, their questions of their ethnicity, race, all of that stuff. It has their income information here. You can select their income. They have alternative contacts, which we require to have two. So these alternative contacts can be as a condition, but if we do have them ahead of time, we can put it here. So when we send the application, it's already there and it's not an additional condition once the loan is already sent to underwriting. So let me go back to our loan details here. So when you create the file, it'll send you to this home page. So this loan chart here is what's going to show us how much the borrower has in terms of line of credit, if they're short. It everything with the reverse is based off of the value and how much is being paid off. So it's a free and clear, great. We're not going to put any liens here. But if they do have a current mortgage and they have to pay off, let's say 300,000, right now, this line of credit, once we select it, is going to change. So with the payoff, now the borrower only has 148,000 in terms of line of credit. Okay, any questions so far? Okay, so for HECM, we have this margin here that we can change. So depending on the margin that we go with, it also changes the line of credit that the borrower has. So right now, this 148,000 is with the margin of 2.2. If we were to change that to a lower margin, let's say 2%, the line of credit increase a little bit. If we went with the higher margin, let's say 2.875, that line of credit decreased. So when it comes to setting the margin, it's going to be in the terms, it decreases the line of credit for the borrower, or it increases it, but it's also going to reflect in terms of your rebate. So I'm going to pull up the rate sheet from FAR real quick. Where is, sorry, give me a sec. Okay, so most reverse mortgages lenders are going to send the rate sheet usually about once a week. So this one was last week's rates. So Finance of America does have a proprietary products, which you can kind of think of more of conventional loans if you were going with our regular loans, or our HECM, which you can think of more of an FHA loan. So based on this monthly here, let me actually open up my other screen. So again, I mentioned this margin here. So based on our product here, our monthly cap 5, it's going to be this one here. We're going to go based off our margins, and we're going to go based off of this PLU, which you're going to find this percentage right here at the bottom. So our margin at 2.875 with our percentage at 72%, you are looking at about 5.12% of rebate based off of the initial draw of the borrower. Whatever initial draw that they're going to select, that's what this rebate here is going to be based off of. Okay, now if there were any, if the borrower has any credit history, or they're not able to pay their property taxes or homeowners insurance, the lender can require what they call a LISA account, which is a life expectancy set aside. So think about that LISA account as an impound or escrow account. So the the lender will set aside a certain amount based off of how much they can qualify for to pay for those property taxes and insurance. Okay, so if we were to have a LISA account, note that this line of credit will decrease as well because it's going to be deducted from this line of credit. the next page I want to go over is this comparison page here. This comparison page is what's going to show us the different products. So again, this is the one we have selected. You can also change the margin on this page here. If we add a product, let's say we did the Finance America Fixed product. And let's add one more. They're proprietary. This one. Okay, so here you can compare how much the borrower would be getting. So the HECM product that we selected, it's showing their line of credit of 123,000. This fixed product, it's showing about 44,000. This proprietary one is showing 178,000. So this is the different products you can show the borrower that they can qualify for. The fixed and the proprietary, you can change the rate here as well. But for the most part, most HECMs are the ones that the borrowers tend to go with in terms of getting that line of credit. As you guys might know, the borrower or the borrower, the homeowner, they don't have to pay for their principal and interest. They're only responsible of paying for their property taxes, homeowners insurance, and any HOA if the home has any HOAs. So again, if the borrower has any history of showing that they don't pay for these, it's not going to kill the loan. It's just that the borrower might require to have that LISA account set up. Does anyone have any questions so far?
Brenda, can we actually pause real quick? And because I'm not so sure that everyone knows kind of like the bread and butter or how, in a nutshell, how to explain what a reverse mortgage is. Hyuna, I'm just gonna assume you don't really know what a reverse mortgage is, right? I don't know if Paul is able to hear me right now, but Paul, if you can, do you know in short what a reverse mortgage is? Okay. Is anyone there in the office? Can they ping Paul or no?
I don't think he's in the office
Okay.
right now.
Okay. See, you guys generally know and understand what a reverse mortgage is and how it works, generally speaking. Okay. So Hyuna, this one's primarily for you. But what it is right. So it's like basically an opposite of what's called what we do most of the time, a forward mortgage, right? So all these mortgages that we talk about, like jumbo, non-QM, conventional FHA, these are forward mortgages, meaning you put a down payment of your own money to acquire a property, and the difference you have to take out a loan, right, to give to the seller. That's a forward mortgage because moving forward for 30 years or 10 years, whatever the amortization is, you're going to make payments on it, right? Monthly principal and payments on it. It does, right? Yes. With a reverse mortgage, you don't have to make a payment on that mortgage. So even though you take out a mortgage, you don't have to make a single principal and interest mortgage payment. Okay, that's a reverse mortgage. Now, like Brenda said, taxes and insurance are optional. You can opt to pay it on your own, okay? Or you can build it into the reverse mortgage where you don't have to pay principal and interest, taxes, and insurance as well. Now, there's a caveat to that, but let me explain what a reverse mortgage does. Okay, let's just use simple math. Let's say that you have $1 million property. It's valued at $1 million. Okay. And let's just say that you have currently a $200,000 mortgage or principal balance on that house. Okay. So you have $1 million property and you have a $200,000 loan. But let's say you're 80 years old and you can't make any more payments. And because you're 80, you want to cash out some money to live the rest of your remaining life on Earth very, very exuberantly. Okay, you want to go to Paris, France, you want to go to China, you just want to travel the world. Okay, so but you need money to do so, right? But because of your lack of income, let's say, you can't afford to qualify for a forward mortgage where you take out $500,000 because you have to make a payment on it. Okay, so in a reverse mortgage, what it allows you to do, Paul, see that, thank you for being back on. Do you know how a reverse mortgage works or what it is, like the bare bones of it?
Well, all I know is you don't make a payment, you just receive the payment from your equity.
Yeah.
So
Okay.
that's all I know for reverse
Okay.
mortgage. Yeah.
So yes and no, right? Okay. So kind of going back, I'm going to use an example of $1 million house. Okay. Let's just say an 80-year-old owns $1 million house. Currently, there's $200,000 mortgage on it. Okay. But this 80-year-old wants to travel the world. Okay. Wants to go to China, Paris, Korea, have fun and live it up. But he has no money. Okay. But he not only does he not have the money to go and travel, he doesn't have monthly income to make the payments. Okay. To do a cash out refinance. So enters a reverse mortgage. Okay. So what you can do, in short, forget the numbers. I'm just going to use numbers, arbitrary numbers. Let's say he needs $300,000. It's enough money to go and travel the world. Okay. So with a reverse mortgage, he's going to get a new mortgage like you do a refinance or cash out of $500,000. That $500,000 is going to pay off his existing $200,000 and he's going to pocket $300,000. Moving forward, he doesn't have to pay a single penny on that $500,000 loan. Okay. Now, if his Social Security is enough and he can make the property taxes and insurance on his own, then all he has to do is pay for his property taxes and insurance, and that reverse mortgage will grow at a rate over his life from 500 to, let's say, 550, 510 over the years. Okay, it's going to grow. Now, let's say he's like, Ragnar, Paul, Kiana, I don't have enough money every month to make the property taxes and insurance as well. So you could impound the property taxes and insurance, but what happens is from that 500,000 to the next year, okay, that loan amount grows even at an expedited rate, at a faster rate. So if he was paying it on his own, let's just say that it's gonna year 2, instead of 500, it's 510. Okay. Well, if you do impound it, it might be 515. It eats away at the equity faster. Another way to look at this is this. After 10 years, okay, let's just say that 80-year-old is now 90 years old. After 10 years, he has not paid a single mortgage payment. But after 10 years, that $500,000 loan amount he took out might now, at 10 years later, at 90 years old, $700,000. Does that make sense? Yep. So that $1 million house, it had at the beginning of the reverse mortgage 50% LTV, but because he didn't make any payments, at 10 years later, it's at 70% LTV. So it eats away at your equity. Now, let's say at 100 years, 10 years later, he dies. So from 80 to 100, it's 20 years left over. Let's say his property is still worth $1 million, but his mortgage is now $1 million. Okay? He didn't have to make any payments. He died. Now, let's just say he has a son or a daughter that's left behind. That usually what happens is that mortgage in that property will transfer into the name of the heir. Now, you're saying, well, who the heck wants 100% LTV, right? Loan to value on a house? No one does. How do I sell this? I can't make any money. Well, HECM, which Brenda is talking about, the home equity conversion mortgage, okay, automatically discounts even, let's just say it's $1.2 million. Okay, it's underwater. Let's say the property is valued $1 million, and he took out so much money and he got a bad mortgage rate. Let's say it grew to $1.2 million. Regardless, FHA will discount it automatically to 96.5%. So that loan amount will become $965,000 as opposed to 1.2 or $1 million, so that the heir can then sell it at, maybe not make any money, but at least sell it without being at a loss or a short sale. Does that make sense? Yeah. Okay. So when it comes to reverse mortgages, kind of Brenda is actually going into the specifics and the elements of it. But what the thing that you have to kind of, what she's going over right now, and what we have to kind of understand is at what rate, we have to figure out what rate and how much equity that person can pull out, so that they're not in a position where it outgrows the equity portion. Okay, and what I mean by that is this, is if you take out too much money up front, or if you maximize it, okay, and your rate is too high, there is in reverse mortgages, so it's like, okay, let's just say that this 80-year-old took out the $300,000 and used it all. Okay, let's just say use it all in 5 years. And the borrower was like, I want to take out more money. I love this program, this reverse mortgage. I could take out money and not pay money, right? Well, what happens is let's just say that, so they assume that the property appreciates 3%, 5% every year. If they have enough equity to start with, and let's just say after 5 years, there's additional appreciation, technically, the borrower could take out more money. Does that make sense? The borrower can take out more money, but again, there's a lot of moving variables, right? The interest rate, the rate of appreciation, and really how much money they took out in the beginning. Okay, so it's a very fine, you have to really know the numbers and how the math works here. But let's just say that he took out the maximum, which is $300,000. And let's say he got into a higher, you sold him as a loan officer, you wanted a big rebate, and you took out and you gave him a high margin. Okay, but let's just say 5 years later, there was some appreciation to the property, but because of the high margin, 5 years later, he comes back to you and says, hey, I want to take out more equity. Because of this high margin, and it ate away at the equity too fast, he might not be able to take out more money. That's what I'm trying to say. Okay, this borrower might not have the opportunity to take out more money, even though the house appreciated over 5 years, because its margin was so high, okay, and other variables too, he might not be able to take out more money. Okay, those are kind of the elements right now that that Brenda is actually going over as far as margin. That's what the purpose of that margin is. The margin isn't just how much rebate I can make. It's also setting this client up for the future if they want to take out more money. Okay, I'm going to stop there. Does that all make sense, Hannah and Paul? Make sense, Hannah? You understand it? You can sell this very, very, really easy, right? You are allowed up to a certain amount of equity when you get into a reverse mortgage, and it really depends on your age. So the older you are, the higher LTV you can go. If you're like 65 years old, you're capped at like 30% LTV. Okay, you might not be able to take out a lot of money at all, or at all for that matter, in a reverse mortgage. So it really depends on the age. Okay, and then you don't make payments on what you take out, but just know along the way, okay, every year goes by, that mortgage grows and grows and grows and grows, the balance, because you're not making a payment. Okay, at least I wanted you guys to at least understand that concept of reverse mortgages, so that when Brenda is sharing this with you, it makes a little bit more sense. Okay, all right, thank you. Sorry, Brenda, thank you for that.
Sorry, we can't hear you, Ragnar.
Oh, sorry, Brenda. I wanted to share that because I don't think without the context of how a reverse mortgage works, what you're sharing with us just would be lost on them, I think.
Of course,
Yeah.
yeah. Okay, well, do you guys have any questions in terms of what I did share? Okay, so as I had started to show that comparison page, like I said, that comparison page is what's really going to show the different products that the bar can technically receive, as well as how much money. So again, this line of credit here is going to change based on the margin you guys select, based on the value of the home, based off of how much payoffs they have. Okay, so when it comes to selecting this product, it's if the bar wants to be able to get cash on a monthly basis, this HECM product is most likely going to be the best option for them because they have this line of credit that is going to be increasing as the loan is as the time goes by, but they will be able to get monthly income addition on if they have any like social security or any retirement income. This line of credit, they can use it towards their expenses. Now, for the HECM, they do have to have, if we go to this documents tab, there's this proposal packet. This proposal packet, the bar needs to receive. If we were to say select this, they need this list of counselors. So this list of counselors for HECM, the bar needs to contact any of these HECM counselors to schedule their own counseling session. So HECM requires the bar to have a counseling session so that the bar understands that what they're getting into, what type of loan. This counseling session will be with a third party, and it'll go over all the numbers that we're sharing with the borrower, and just so that the bar fully understands what type of loan that they're getting into. Here in California, we do require a waiting period. So once the bar completes this counseling and we get the signed counselor certificate from the borrower, we have to wait 7 days, which is what they call a cooling period. 7 days before we can fully submit the loan to the lender in underwriting to request an FHA case number, to open escrow and title, to order an appraisal report. So with this reverse, we can order the appraisal as soon as we hit that 7-day mark before it gets sent to underwriting. Depends on if the bar has a little bit of time, or if you guys want to wait until we get that initial review from the underwriter before we order the appraisal, we can do that as well. But just note that we do have to wait that 7-day cooling period before we can actually do anything, because here in California, the bar needs to have completed this counseling, and they need to have that 1 week of them to kind of think through whether they want to proceed or not with the loan. Okay. Any questions? Okay, so once the bar has done their counseling, that's when you as a loan officer will be sending all the stubs. So any income documents, bank statements, any mortgage, any property documents. So the mortgage statement, homeowner's insurance, HOA statements, all of those, including the signed application. That's when it gets sent to the processing team, and that's when the processing team will take over. So you guys, as the loan officers, do send out this proposal. Once you receive it, once you let us know that the borrower has completed the counseling, we can send out the application. Once that application is signed, that's when the processing team will start working on, all the opening up escrow, requesting that FHA case number, whatever the case may be, to start the loan and sending it to the underwriter. Okay. I think that's about all the information that I have based off of this. But do you guys have any questions? Anything that you guys want me to go over a little bit more?
Hey, Brenda, I have some questions. And so you mentioned with documents, you mentioned income statements. So with the elderly, what if they don't have income? I mean, besides like their
So
social
other than like Social Security or, yeah, so usually if obviously if they're retired, we would need if they receive any retirement income or if they receive Social Security, then we would just request the award letter. Or sometimes they will take, if they get direct deposits, sometimes we can provide 2 months of that direct deposit going into their bank account.
Okay, so income statement is important. What if like they're retired and actually the reason they want the reverse mortgage is because they're in financial trouble? So, I mean,
So reverse mortgage, it's not so they don't go based off of your DTI.
mhm.
So they do what they call a residual income. They have a different calculation where they go based off of the living space where you live. And then, so they do have to have a certain amount of income, but it's not based off of our DTI where we're required to be at under 50%.
Okay.
So it's not going to be where their income is. They need to have a lot of income. They just need to have enough income to cover that. Sometimes it can be like, let me see if I can share my screen again real quick. So on this portal here, if we go to our assets and income here. So if we were to enter our income, so let's say they have Social Security. Okay, and they get, I don't know, 2,000, right? So if we go to this financial assessment here, this is what it's, once we input all their expenses, but this is how much they are required. So this borrower at the household of one, they're only required to have at least 589,000.
Wait, 589, 589, not 589.
Sorry, not 1,000. Yes, you're right. $589. So it's based off of a household of one, and this would be based off of just the living space of the home too.
Hey, on for residual income, basically like a VA has this and FHA has it too. It's I forget all the elements. Maybe that's something that we could, I don't know, Brenda, if you can look it up, not for today, but for next time. But residual income, it kind of says it right there. It says like maintenance and utility charges. It's basically like they factor in the cost of living on a very low to moderate scale of like, food, just necessities, right? And so look, so what that is showing there is it's about $1,400 that someone needs to live. And if you have $2,000, obviously there's left over $600. But and what's left over after these minimal expenses is $600. Right? That's what this. I'm just explaining what this cash flow residual income is.
Mm-hmm.
And that's $600, or that 589, or that $600 meets the 589 residual income. Like that's how much is required to be left at the end of the day every month in their pocketbook, so to speak, to qualify for this. Yeah. So actually, Brenda, can you do us a favor and put in like 1,000 for Jane Smith?
Income?
Yes. Yeah. See, so there's not enough leftover funds, right? And so they won't qualify for this. So that's what the residual income instead of DTI, that's what that is.
Understood. Thank you.
And just to kind of go back to, if you weren't confused, especially for Paul and Hannah, you have the option of taking a large lump sum out, or for whatever you're approved. So let's just say that maximum was 300. You can take out nothing with a line of credit of 300,000, and you can pull out that money like a credit card or like a line of credit. Does that make sense? So instead of taking that full $300,000 right away, right, a cash out, you can just leave it as a line of credit to use whenever you need the funds. Okay. Will we all be getting set up for that site? Sorry, I forget what it's called already.
Quantum reverse? Yeah.
Yes. Okay, that's
I
great.
can, I'll issue or like send out the credential
Okay.
email to have you guys set up
Okay.
if you
And
guys don't have it.
okay. And just to kind of confirm again, so that is a platform, or it's almost like a operating system where every reverse mortgage company uses to input their scenarios.
For the most part, most lenders, yes, use this one.
Okay.
Like I said, the only one that we use that doesn't have this one is Money House.
Okay.
Money House has their own separate portal or platform that they use.
Okay. Gotcha. And exactly how much information and how much input are we as a loan officer doing? Or is it just simply to get some type of a scenario, a comparison?
So in terms of the scenario, you guys, just what I entered is the basic information. But like I said, if you guys go through the full, like the bars section where it requires all their social security, where they've lived, how long they've been married, or if there's additional borrowers, you would add the borrower. That you can't add it. Like I said, it's going to send the application. And essentially, when the application gets sent out, if it's not inputted, then the borrower technically has to input that information. So it's easier, they're older people. So it's easier if we enter it in, so that way they don't have to put it in. Like I said, for example, the alternate contacts. If we don't put it in, the bar doesn't put it in, it's going to be conditioned where we're going to have to input it in. So we're going to get it for the underwriter. The writer is going to condition. So whatever is missing, if we don't put it in and the bar doesn't do it when they fill out their application either, it's going to be conditioned to where the underwriter is going to ask all these conditions. Like, for example, they don't call it 1003. I think it's a 1007, what they call it. I can't remember. The loan application, if it's missing the bar's social security or the bar's mailing address or whatever the case may be, the underwriter is going to condition for the application to be completed.
Okay. Oops.
Any other questions?
Actually, so here's one. When we're running, let's say, scenarios or illustration for our clients, for appraisal, I mean, should we just pull it off of one of the other, like realtor.com or Zillow or something like that? Or do we
Yeah,
CMA?
the value, you guys can run it through the different, like Zillow or all of those. I think last time I sometimes eappraisal.com has values and sometimes it doesn't find the property. Sometimes I use that. We can't, if it is here in, you know, Orange County, LA County, we can assign the appraisal to one of our appraisers. So if we go with, I think Longbridge and I think Money House, we can assign it. Finance of America, I think we do have to go with their own AMC, but in terms of the value of the home, yeah, it's very similar to what we would do with a forward mortgage, where we can request for value checks,
Okay.
just so that we can, as the value of the home is like one of the main requirements in terms of how much the bar can get back.
Okay. Thank you. Last one. Margins. What's typical margins we charge?
Typical margins we charge, it really depends. I've seen it whenever I talked with the AEs, they always say it's between like 2.25, 2.125. Like I said, we can go higher or lower, but that's usually around what they usually tend to see, what's standardized.
Okay. Got it. Thank you.
I did not tell you guys, I just kind of remembered, origination. For HECM, you guys can charge max 6,000. So that 6,000 origination is going to include essentially the processing, because there's no processing or underwriting separately. It's going to be a max of 6,000 origination. That 6,000 origination you can decrease. Let's say if you want to go with the higher margin, you can play with the origination and charge less origination if you want to. Or if you want to go with the lower margin, you can charge the full 6,000. But note that you can't go over the 6,000 origination. Any other questions? No.
All right. Well, thank you, Brenda. Appreciate that. Yeah, reverse mortgage is really another. I mean, really, especially with the baby boomer generation and retiring, getting well into of age. It is a huge opportunity, guys. Especially right now as we are dealing with what we are economically, especially in California with the high cost living, guys. If this is something you want to embark on, okay, meaning this is a market you want to capture and generate leads from, let's have a very, very honest and serious conversation. Okay. We all have parents that were I think we're all kind of similar in age, right? Like in our 30s and maybe 40s. I know Anna and myself were in our 40s, but my parents were born in 1954. They're 70 years old. They don't own a home, but a lot of their peers do, right? So for those who are probably parents that are a little bit older, in their 75s, probably 80s, and they own properties, it's a struggle to live in California right now. Property taxes are going up, the cost of living is going up. So reverse mortgage is a real option. Okay, if you love talking to elders, if you're around and exposed to a lot of elderly who own homes, it is you really should give it a really strong consideration in marketing this. I'm telling you right now, not a lot of loan officers market reverse mortgages. Most people don't know how it works and they don't care to study it. It's not that difficult. If you're good with numbers and like projections, you'll pick this up very quickly. Okay. So that's my quote unquote little homework assignment for you guys. especially for Paul, perhaps On and Hyuna. If this is something you want to consider, give it a long, hard thought, and really, if you can market this very well, and it's when I say well, it's just be consistent. That's all it is. Have a few flyers, have a few email drafts, and constantly push it out. Even hold seminars. If you want to, we can hold seminars like at a golf country club or at a restaurant or at a wherever. And just invite elderly folks who are homeowners. If you think, let me put it this way, if you believe that the United States of America is going to get harder and harder to live, it's going to get more and more expensive to live because the cost of goods is going up, this really is a program you guys should be pushing. I cannot say that enough. Okay? We can have a hard talk about this. Well, thank you guys. I know we went way overboard. Brenda, thank you so much. You guys have a great day.
Oh, Ronner, very quick. Just want to share. FAR, the website has an illustrator, so with the numbers, you can actually use and see the numbers visually.
Okay, good. Good to know.
Mhm.
All right. Thank you guys.
Thank you.
Bye.
Bye.